Welcome to my second lecture, all you need to know about value investing, how to beat the market while taking on less risk. Today I'll cover the most important principle in value investing and answer common questions. So none of these ideas are my own. I'm just trying to tell you what Buffett and Munger would tell you if they were here. And actually I'm trying to teach you what they did when they were young and worked with less than $1 million in capital, because what they're doing today with Berkshire Hathaway, which is worth more than $1 trillion, that doesn't really apply to our situation. So let's go back in time to the 1950s and try to figure out what these guys did and why it worked. So the core principle of value investing is that there's a difference between a good asset and a good investment. Good assets are easy to identify. It's companies with a competitive advantage that generate strong profits. Like you can see here, the Magnificent Seven, Apple, Amazon, Nvidia, Microsoft, and all of these guys. They are great companies, they are great assets. But it doesn't always mean that they are a great investment, because it depends on the price. Other examples would be market leaders in growing industries. So if you know, like there's an emerging industry and somebody's dominating it, of course, that's a great situation to be in, probably a great asset. Is it a great investment? I don't know. And prime real estate in top locations. So if you go down Fifth Avenue, of course, all these buildings, they are great assets to own, but we don't know if they're great investments. So buying these assets does not guarantee a good return. The Magnificent Seven are down between 8% and 40%, 42% this year, while there are other companies, like the logo I put up here, Fores, a tiny company from Germany, 15 million in market cap, nobody knows it, and it's up 41% at the same time. So the left are great assets, the right is a not so great asset, but the price really makes the difference and turns one into a great investment and the others we'll see. So a good investment means buying something for less than it's worth. And this is so simple, and you will try to find more complicated aspects of investing, but it's actually that simple. How do you do that? Well, rarely you will find great assets at great prices. That usually only happens during a crash. Sometimes you will find great assets at fair prices, and most often you will find average assets like Fores at really, really great prices. And that makes them a good investment. But the type of asset doesn't matter. Stocks, bonds, real estate, private businesses, none of that matters. What matters is whether you can estimate the true value of the asset with enough certainty. If you don't know if you're able to do that, you're not. And you shouldn't make any investment decisions yet. You can either put your money in an index ETF and achieve the average market return, or learn how to value assets to find investment opportunities that outperform the market. That is not complex, but it takes time and effort, so I believe you should only try it if you think that learning about businesses or other assets is fun and rewarding beyond the potential to make you rich. So let's get into it. How do you estimate the actual value, it's often called the intrinsic value, of an asset? I can tell you this much, it's not the price, that would be easy. It's the amount of cash that the asset will generate over its entire lifetime, discounted to reflect the time value of money. So for example, if you find a machine that prints $10 a year for 5 years, it's worth about $50 discounted to today. Simple as that. So most assets like stocks or real estate have a very long lifetime, and nobody is able to predict the cash flows for each year in the future with accuracy. The more you try, the higher the risk of being very precise but also very wrong. and we always want to be roughly right instead of precisely wrong. So I will show you a better way to value an asset in the next lecture, Basics of Business Valuation. But for now, just trust me that there are assets out there that you will be able to value with a high degree of certainty. So if you come up with an intrinsic value estimate and you have a lot of confidence in that estimate, then the price is really the only thing that matters. If an asset is available at a price that is much lower than your intrinsic value estimate, it's a great investment. If the price is higher than the value, it will not be a good investment, even if it's a good asset. It doesn't matter if the stock just doubled or crashed. It doesn't matter if it's a growing or shrinking industry. It doesn't matter if it looks cheap or expensive compared to peers. The only thing that matters is that the price is significantly lower than the intrinsic value. And this is the fundamental principle of value investing. Assets have a true value that often differs from the market price. If your estimate is solid and you can buy well below that, you found a good investment. So you don't need to know much more about value investing. That's all you need to know, in fact. But your uncle, your neighbor, or your financial advisor, they will have seemingly valid objections. And I want to make sure you're not discouraged easily. So let me explain some more concepts and answer frequently asked questions about value investing, just to be very sure, but to be honest, just knowing the basic core principle and then learning how to value businesses or other assets, that should be enough. But let's look at the questions. First question, what return can a good value investor expect? So valuing businesses is a lot of effort. And in my view, that should be rewarded. So a good value investor has to beat the market by 5 percentage points on average, maybe 10 per year. If you're much worse than that, then there's really no sense in doing all the work. You could just buy the ETF, the index ETF. So over the last couple of years, that would be about 20% return per year. But it's unlikely this market performance will continue. So for the next years, 15% is a good goal in my view. And that's very hard to do over a long time. But if you constantly invest in assets that cost 50% of what they're worth, it's definitely possible. Next question, what about growth stocks? Haven't they outperformed value stocks over the last year? Well, I believe this distinction isn't helpful at all. Growth is a part of value. Growth can add value or destroy value depending on the required capital to achieve that growth. So let me give you an example. If you have a company that has 10 million in assets, generates 1 million in cash per year, it's a 10% return. Now, 10 years later, we look at the same company, it now achieves 2 million in earnings per year. And you say, wow, it has doubled. That's great. But what if that company required 100 million in capital to achieve that additional 1 million in earnings? So the incremental return on the assets will just be 1%, lower than any government bond. It's really, really bad. On the other hand, if you have Google, they don't really have any costs if you click their ads. So if they launch 3 new countries and now people start clicking their ads, yeah, they grow without adding capital. That's great. So a good value investor understands growth. They don't shy away from growth. In fact, they embrace it. They love businesses that grow like crazy without requiring more capital. You can call those stocks growth stocks if you like, but the thing that really matters is, do you understand the company? Do you understand the bet? And if you do and it looks good, then you go all in. So nothing wrong with buying growth stocks at the right price. My favorite question, what about real estate? And I already told you that asset classes don't really matter, so that's the core of the answer, but there's some more emotional aspect of it. Let me say first, if you want to buy a house because you see your family live in it and you like it and it's an emotional thing for you, just do it, that's fine. I'm not talking about the emotional part of it. It can be a great decision. I'm talking about real estate investments to build wealth. So buying a couple of properties, mostly on leverage, to get rich quick. Many people think stocks are risky and real estate is a safe way to get rich. So they avoid stocks, but have no problem taking a huge loan to buy property. This bias is very costly and it's absolutely crazy. The true risk of any investment depends on the gap between price and value, not on the asset class. There are low-risk stocks out there, and there are high-risk real estate deals out there. The right way to think about it is this: what are the opportunities within my circle of competence that I really understand, the assets that I can value with high certainty? Then you rank them, and you take the best ones, no matter if it's a stock, a bond, a property, or even a university degree or a public speaking class. If the returns these opportunities offer are not enough for you, you can decide to use leverage. Leverage, debt, amplifies returns, but it increases risk. 50% leverage means that losing 50% of your investment will wipe you out completely. Whether it's worth taking that risk depends on your personality and on the quality of the investment opportunity, not on the asset class. Over time, price and value of an asset tend to converge. So if you overpay, you'll likely lose money with stocks or real estate. And with leverage, the losses are bigger. The idea that you should be afraid of stocks but can sleep well with highly leveraged real estate investments does not make sense at all. Next question: how can my intrinsic value estimate be more accurate than the market price? Many academics have claimed for a long time that it can't, because all the information about a company is already reflected in the share price. That's called the efficient market hypothesis. It's often true, but certainly not always. Consider that the economy, in terms of GDP, doesn't move much. Up 3%, down 0.5%, up 2%, not much volatility. Companies' earnings move a little more, but stock prices move a lot more, like crazy. That cannot be reflective of true changes in underlying value. Buffett's teacher, Ben Graham, he called this phenomenon the Mr. Market. Imagine Mr. Market is your crazy neighbor who yells prices for your property over the fence every day. And sometimes these prices are really high, sometimes they're low, and you can decide to buy at the price, sell at the price, or do nothing. Most of the time, what he yells will be close to the actual value of your property, but sometimes he'll be off completely, and then you act. You don't have to act if the prices are close to the actual value. You can act when it's way lower, then you just buy his property. If it's way higher, then you sell him your property. And that way, a crazy neighbor can never increase risk or anything. It's just an opportunity for you to act or not act. That's upon you to decide. But of course, you can never be sure that your intrinsic value estimate is more accurate than the market price. So there are some safety mechanisms to protect you. The most important one is the margin of safety. Margin of safety means if your estimate comes out at a valuation of 1 million, you don't buy for more than 600,000. You always have this kind of buffer of 40 or 50%, just in case you're wrong 40 or 50%, you don't lose all that money. The other thing is asymmetric bets. So you're looking for risk asymmetry in the bets that you're placing. Mohnish Pabrai calls this heads I win, tails I don't lose much. So you focus on downside protection. That basically means that even if you should be wrong, you don't lose all your money. There are many situations out there where you say, the probability of me being right is just 20, 30, 40%. And if I'm right, my money will double or triple or whatever. But then you don't want the other 50, 60% to lead to a complete wipeout, to a complete loss. You always say, you're always looking for opportunities where you if you're wrong, you lose 10%, 20%, it's not that bad. The third point is that you have to stay within your circle of competence. So stick to what you know, learn a lot, read a lot, but don't do anything outside your circle of competence, because then you cannot be sure about your value estimate. How do I know that the price will eventually match my valuation? I mean, you buy something that's undervalued, but if it stays undervalued for a long time, how can you ever make money? Well, you cannot be sure that price and value will converge, but it also doesn't matter as long as the management is shareholder-minded. Let's take an example. A company generates 1 million in earnings and is valued at 5 million. You think it's worth twice as much, and so you invest. But the valuation, the stock price, never increases. It always stays at 5 million. But you will earn 20% on your equity each year. 1 million in earnings on 5 million investment. That's your money, at least your share of it. A shareholder-friendly management will return that cash to you. In this scenario, hopefully through share buybacks, but dividends would be fine too. Maybe they even find ways to retain these earnings and invest them in the business and generate more earnings in the future. So after 5 years in this example, you will have made all your investment back just based on the dividends or whatever way the management chooses. And that way you don't really need to worry about the share price in the long run. If the management is not shareholder friendly, they might just waste all your money, retain these earnings and put them in risky investments that don't work out. Then it's a huge problem, but then you shouldn't have invested in the first place. So, 2 more questions, I guess. How many stocks should I own in my portfolio? What about diversification? Just think about this. Many rich people have their entire net worth in one stock, the company they started, that made them rich. And think of all the private businesses out there. Are their owners worried about diversification? Would they prefer to give away 95% of their company just so they can spread their capital among 20 companies instead of one? I don't think so. If you really know a company well, and you know what you're doing, I don't see a problem with the idea of owning just one stock. But if you're analyzing companies from scratch, you will find multiple investment opportunities with a similar risk profile. So you might prefer to allocate the same amount to each of these opportunities. That's a good idea. In that case, I recommend to not hold more than 10 positions at the same time. As long as you are very confident that you bought each of them for 50% of what they're worth, 10 companies is enough diversification. It's a lot easier to find 10 undervalued companies and follow them than to find 30. A portfolio of 10 stocks or less will fluctuate a lot. It will be very volatile, and some people will tell you it's therefore very risky. That's a weird definition of risk. If the value stays the same, how can the crazy neighbor that shouts prices over the fence every day increase your risk? You don't have to act. The only right definition of risk is the common sense one, the likelihood of permanently losing capital. And I believe that the likelihood is very low if you spread your capital among 10 companies that you have studied intensely and understood well and found to be undervalued. How long should I hold a stock for? Great companies you should hold forever. If they're returning a lot of money on their invested capital and they have competitive advantages and you bought in at a decent price, just stick with them and you'll be fine. That's a great approach. But generally, we will invest a lot, as value investors, a lot in not so great companies that are just cheap and undervalued. And you should generally hold those companies until they reach your estimated valuation. But I recommend a minimum holding period of 1 year because value investors are conservative and they often estimate an intrinsic value that is too low. So if your company reaches the estimate after 6 months, just wait a little longer and see what happens. You might be surprised. Last question, how do I start? And as I said in the beginning, these ideas are not mine, so I recommend the primary sources, the writings of Warren Buffett and Charlie Munger, and I will link an article where I've summarized the most important resources, books and articles and annual letters of these guys, so you can read them and enjoy them and learn everything I just summarized from scratch. But I think you like it, you probably enjoy it as much as I did. And then there are also very good books on investing that I will link in the notes too. A link to my 10 favorite books on investing, and I hope you enjoy them too. So good luck, and I hope I can help you. Next time we will look at the first business analysis. Looking forward to it. Thank you.